Welcome back, friends. Today we'll start with depreciation accounting. In short, accounting standard 10. So, before I start, I would like to give you a brief introduction about accounting standard 10. Accounting standard 10 is actually property, plant, and equipment. This is the actual accounting standard's name. Under that, we'll be covering depreciation. So, I'm assuming that in 11th and 12th, you have not even touched depreciation, or you're a new student to the entire accountancy and you're reading accountancy for the first time in CA Foundation. So I'm going to start as if you don't know anything and we're going to start from scratch. So don't worry. Before we start, write down this definition of depreciation. This is the actual original definition. And before I start, I'll explain this definition fully. And every single sum that has ever been thought of by an examiner or an examiner can even think of will be covered in this chapter. You don't need to worry. I'm going in a sequential way so that every single aspect is understood clearly by you. Let's start. Write down the definition first. Depreciation is charged on depreciable assets on its depreciable value over its depreciable life. Yeah, it's a little bit of a funny definition, but this definition is very important to understand before I proceed. So, underline depreciable assets, depreciable value, and depreciable life. These three are the key terms that need to be understood before I proceed. So, what is depreciable assets? So, write this down. Depreciable assets is basically any fixed asset. See, I've given you the full overview of depreciable assets definition in the basic accounting terms. So, let's start directly. So, depreciable asset is fixed assets. If you have any doubt, go through the basic accounting terms chapter once before you go to the next lecture. But you won't need it because I'll explain it fully here. So for now, just pay attention. Any fixed asset is a depreciable asset. Fixed asset can be what? It can be machinery, it can be building, it can be bike, it can be car. Any fixed asset is a depreciable asset. That fixed asset is any asset that is a physical property and that can be used for over 1 year. That is the general definition. For now, you keep that definition in mind for this chapter of depreciation. Now, fixed asset, there is only one exception to this rule of fixed assets when it comes to depreciation. Every fixed asset is a depreciable asset except land. See, it's a simple concept. Usually, land value appreciates. Land value can never depreciate. That is the concept. So, except land, every fixed asset is a depreciable asset. Now, there can be a question in the exam just to test your conceptual ability. They can say there are two types of land. One is a leasehold land and another is a freehold land. See, I'm going in depth now so that you won't face any difficulty during your exams. So, leasehold land, freehold land, there are two types of land. So, in this, leasehold land is also a depreciable asset. But freehold land is not a depreciable asset. So, when I say fixed asset is a depreciable asset except for land, if they just mention land, you say that we can't charge depreciation on it. But if they mentioned leasehold land, then you have to charge depreciation on a leasehold land. But freehold land, you do not. Usually, if they just mention land, except instead of telling it's a bifurcation, you mention that we can't charge depreciation on it because it's assumed that it's a freehold land. Why is a leasehold land a depreciable asset? It's a very big concept. For now, you keep this in mind that a leasehold land, you have a right to use the land for a period of time. So, because you have the right, it's also depreciated. The value of the right you have depreciates over a period of time. That's why depreciation is charged on a leasehold land. But freehold land is your own property. Land value always appreciates. So we don't charge depreciation on a freehold property. That's it. Now moving to the next two important terms. So for the explanation of the next two important terms, I'm going to give you an example here. Write this example down for the full understanding. Cost of machinery 6 lakhs. Economic life 5 years. No, right, I'll explain. Wait. Scrap slash residual value is 2 lakhs. This is the question. You have to calculate depreciation. Now, cost of machinery is direct, you can understand it directly. Now, what is economic life? Now, economic life is for example, you buy a machine. Usually, when you buy a machine, experts estimate that it lasts for certain number of years. The machine will work for certain number of years. So that life for which it will work is economic life. So that is 5 years in this case. Now, economic life is always estimated. You can't say exactly how many years it will come for. So economic estimated life. So when I say depreciable life, it means economic estimated life. The second term is clear. Now the third term, depreciable value. Before that, wait. Now what is the scrap slash residual value? So assuming you purchase this machine, you're estimating it'll come for 5 years. After 5 years, its value is completely depreciated. You don't know what to do with the machine. So it stopped working. So you go to some scrap dealer and you sell it for 2 lakh rupees to him. So that is the meaning of scrap or residual value. So the value that is left after the economic life of a particular asset is called the scrap or residual value. So this value is also estimated. Scrap or residual value is also estimated at the time of buying the asset itself. So after you estimate it, you think that okay, so 2 lakh we are going to we are assuming we'll get 2 lakh when we sell it to scrap dealer and come for 5 years. And the asset is for 6 lakh. That's how every asset is purchased. At the time of purchases, these two are decided. Now, what is depreciable value? Wait, I'll give you the proper definition and formula for depreciable value. Depreciable value is equal to cost of asset minus scrap value. So in this case, cost of asset is 6 lakhs. Scrap value is 2 lakhs. So depreciable value will be 4 lakhs. Now what is the meaning of this formula? Depreciable value actually means the value on which depreciation will be charged. So the question is, why are we charging it on 4 lakhs instead of 6 lakh? Because we purchased the asset for 6 lakh. Now, when we buy itself, we determine scrap and residual value. So we know that whatever happens to the asset, we are going to get 2 lakhs at the end of 5 years. So when 2 lakhs is going to be recovered, we know we are going to get 2 lakhs. So why should we charge on 6 lakhs? 2 lakhs is confirmed, right? So we'll charge on 6 lakh minus 2 lakh. This 4 lakh value we are uncertain about. So we'll charge depreciation on this 4 lakh value. That's the concept of depreciable value. Now, we just told, now I explained you depreciable assets, that's fixed asset except land, depreciable value, or and depreciable life. These three explain. Now, how to calculate depreciation? What is the formula for calculating depreciation? Come down, write this down. Depreciation is equal to depreciable value by depreciable life. Now, this is the basic formula you need to keep in mind. Over the course of these 6 lectures, I'm going to upload 5 more lectures for complete concept of depreciation. Every single sum in the exam will be covered here. You don't have to look at any other material. You just have to look at these lectures and the PDF given below. Now, for now, you keep this definition in mind. So, depreciable value by depreciable life is the formula for depreciation. So, what is the depreciable value in this case? It's 4 lakhs. What is depreciable life? What is depreciable life? Economic life is depreciable life. So 5 years. 4 lakh by 5. Once again. So 80,000 is the depreciation rate per year. Now, what is the meaning of this per year? Now, we purchase this asset for 6 lakhs. We know we are guaranteeing that we get 2 lakhs at the end of 5 years. So 4 lakh rupees we are not sure about. So 4 lakh is the amount we should depreciate. So it will come for 5 years. So 4 lakh should be depreciated over a period of 5 years. So how much should you depreciate over 1 year? 4 lakh by 5. If 4 lakh should be completely depreciated at the end of 5 years, per year it's 4 lakh by 5. So 80,000 in the first year will charge depreciation, second year will charge depreciation, third year will charge depreciation, fourth year, and fifth year. After the end of 5 years, this 4 lakh value will become 0. The remaining will be 2 lakh. That will get from the scrap dealer. That is the concept of depreciation. For now, you keep this in mind. While doing the question, everything has to be clear. Now, this is the basic idea of depreciation. Now, the main part is we'll go to the next part of the chapter. That is part number 2. Write it down. Just write as and when I'm telling you to write. And write with me. You will understand with me then. Now, in this chapter, we'll read this. Methods of calculating depreciation. First method, SLM. Second method, WDV. Third method, production unit method. Now, the one another question I get from my students when I teach this part is, I told you the formula for depreciation is this. Then why am I telling you these other 3 new types of calculating depreciation? See, if no type is mentioned and the question is given in this format, you use this formula. This is the basic formula. But other than that, when they mention this name of the method, you use the formula I'm going to tell you in the future. Everything will be part of your muscle memory by the end of these lectures. Right now, just pay attention and trust me completely. We'll do it together properly. Now, SLM's full form is straight line method. WDV's full form is written down value method. Now, these both have different names. Like SLM is called straight line method, or it's called fixed installment method, or it's called original cost method. Then WDV is called reducing installment method or diminishing value method. Production unit is also called unit of production method. All these names, I've given it in the PDF. Just go through it. But even while doing the questions, I'm going to use different names while solving this question. So that any name they ask, you don't get flustered during your exam. Your concept is very clear that you know what you have to do when. Okay. Now, for understanding these methods, these 2 methods will be used mainly. So today's lecture, I'm going to mostly focus on these 2 methods. If you understand these 2 methods, this third method is going to be very easy. Now, if you have read it in 11th and 12th, it's fine. Anyway, I'm going from scratch. Even if you have not read it, you will have the same impact. You're in the same level of people who have read it. Now, even if you have read it, you learn a lot of new things here and your concept will become completely clear because depreciation is one such chapter that the entire concept is never explained to you properly in any level. And because of that, you tend to memorize, not essentially memorize, but you tend to start remembering the way of doing the question instead of understand the concept. That is, you do 5 questions, you know how to solve those 5 types. If something is asked except the type but part of the same concept, you won't be able to solve. That's the reason why CA course is a little different. Only if you understand the concepts fully, you'll be able to do it. And that's why these videos are very sequential. I want you to understand each and everything so that any question I ask, you'll be able to solve easily. Now, to understand these two methods, I'm going to give you a question. Write this here, right? SLM here and WDV here. Yeah. First, underline it also. Now write this down. This is an example to understand both these methods clearly. Cost of machine 5 lakhs. Here also it's 5 lakhs. Because the same machine, the methods are different. Rate of depreciation 10% per annum. Okay. Now I'll explain this per annum and the percentage also clearly because even after you completely understand the concept, there are few places where the examiner can trouble you. Like small places such as percentage, per annum, what is 10% per annum? Sometimes there are just 10%, but the treatments for both are different. So that also I'll explain properly. But right now, just listen to this. Now, how do we calculate depreciation in both cases? Let's start with SLM first. First case. Cost of machine is 5 lakhs. Now, depreciation for first year, they say is 10%. So 10% on what? 10% on the cost of machine. Now, don't get confused by this one. I told you depreciation, depreciable value by depreciable life, and depreciable value is cost of asset minus scrap value. If such terms are mentioned, if cost of machinery is given, if scrap value is given, if economic life is given, then you calculate depreciation using this method. But here, no such thing is given. Directly, cost of machine is given, rate of depreciation is given. In such case, you assume this 5 lakh as the depreciable value. Okay? And you calculate this 10% on this 5 lakh cost of machinery directly. So first year depreciation. So you buy, example, you buy this on 1st April 2022. And at the end of 31st March 2023, it's been 1 year for the whole financial year. So 10% per annum for on 5 lakh is at the end of the year, you charge 50,000. That is 10% on it. So when you charge 50,000 rupees, what is the value of machinery that's left in your books? 5 lakh rupees is your cost of machinery. 50,000 rupees you're charging from the machinery. That much is getting reduced from your machinery's value in your books. So right now your machinery's value at the end of the year is 4,50,000. So what is this called? Return down value. Now don't get confused with the method's name. This value at the end of the year after charging depreciation is called written down value or book value. Now, this concept was fully explained in your final accounts of sole proprietorship and every other chapter before it. That's why I kept depreciation after those chapters. But even if you didn't read those chapters, don't worry, everything will be explained here. Just be a little patient. For now, you understand that at the end of the year, from the 5 lakh rupees machinery is cost, 50,000 rupees is reduced because of your depreciation. This depreciation goes to the P&L account. This is the basic concept. Full concept will be explained later. But for now, this 50,000 goes to the P&L account. So in order to balance both sides, 50,000 goes to the P&L account, which will reduce your capital account. So credit side gets reduced by 50,000. This whole concept was explained in journal entries. Credit side by 50,000. So debit side also should, both sides of balance sheet should tally. So for debit side to get reduced, 50,000 is subtracted from the value of the machine. So 50,000 gets reduced in your credit side because P&L's loss of 50,000 gets transferred to the capital and is minused from your capital. And this 50,000 gets reduced from your machinery's value. So both sides tally. Now we are assuming only 50,000 loss was throughout the year. That's why this 50,000 I'm telling gets subtracted from your capital loss account. This is the only loss during the year. To understand the whole concept, just have a look at the journal entry concept and the ledger account concept before this. Then only you will understand it clearly. If not also, if you're able to understand, just continue. Now, written down value is the book value at the end of the year after charging depreciation. This is year one. Now, after year one, then 31st March of 2024, another year passes from this date of 31st March 2023. So when another year passes, again depreciation should be charged because it's 10% per annum. So now what do we calculate depreciation on? Under the straight line method, it is always calculated on the cost of machinery. So 5 lakh into 10 percentage again, that is 50,000 rupees. Now, why I am telling you this, you will understand clearly once when I explain the WDV also. I am explaining it side to side so that to show you the clear cut difference. Whenever I say SLM, you calculate 10 percentage on the cost of machinery irrespective of which year you're charging depreciation in. So year 2 is 50,000 rupees. Again, now written down value or book value at the end of year 2. Written down value is another name for book value. It's not the method. It's another name for book value. Now, 4 lakh rupees. Correct. So this is the value of the machinery in the books of account on 31st March of 2024. Now, finally, again we'll do it. Now, depreciation now on 31st March of 2025. Now, we assume another year passes. Now, you have to charge depreciation again because it's the third year and 10% per annum. Now, what? Again, I told you, whenever it's SLM or straight line method, depreciation is always calculated on 50,000 rupees, on 5 lakh rupees. So, 5 lakh rupee again into 10 percentage, 50,000. Again, now written down value or book value on 31st of March 2025 is 3,50,000. Now the same goes till this entire 5 lakh gets reduced. That is, it'll be for 10 more years. Because 50,000 for this year, 50,000 for this year, 50,000 for third year. Like this, 7 more years, we depreciate for 50,000. Finally, the value, book value, written down value for the machinery will become 0. Till then, they'll depreciate the asset. This is the concept of straight line method. Now, let's come to WDV. Now, the only difference in WDV is for the first year is the same. When SLM and WDV, while charging depreciation for the first year, the way to solve under SLM and WDV is the same. Here, 10 percentage you have to solve on 5 lakh rupees. So, cost of machine is 5 lakh. Depreciation for the first year will be 50,000 only because it's 10 percentage on 5 lakh. Now, return on value at the end of first year is 4,50,000. Now, here's what separates the concept of SLM and WDV, return on value method. Now, another year passes. It's 31st March 2024 now. Now, you have to charge 10% depreciation again. Now, what? Now, apart from the first year, under WDV, you always charge depreciation on the written down value. Written down value is 4,50,000 in this case for the year end. So 4,50,000 into 10 percentage, that is 45,000, is the depreciation for year 2 under WDV method. Now, what is the written down value or book value at the end of the year 2? Same, 4,50,000 minus 45,000. 4,05,000. Now we'll do it again. Now, year 2 also we depreciated the machinery for. Now it's year 3. You have to charge depreciation again. Now on a WD, what do we charge depreciation? On what value should we charge depreciation? Again, return down value as at the start of the year. See, 31st March 2025 return down value is 4,05,000. If 4,05,000 is the return down value or book value of the machine on 31st March 2025, on 1st April 2025, that is the start of the next year, the value will be same. On one day, the value doesn't change. So, return down value is actually charged on the value of the machine or the asset on the first day of the year on which depreciation is charged. That is, now what is this? 40,500 is the depreciation for year 2. Correct? Now I need you to understand a very important concept here. I hope you paid attention to what I was telling you when I was talking about depreciation for WDV. When I told you that the depreciation for WDV is always calculated on the value of the asset as on the first day of the year on which depreciation is charged. So in this case, now let's do this. The remaining value is 3,64,500 rupees at the end of the third year. Okay, it's 2025. So this is 2026. It's 2025. Now, for greater conceptual clarity, draw a timeline. So 1st April 2023, 1st April 2024, and 1st April 2025. Now, machinery's value, for example, say it's 1 lakh here. So the machinery was used throughout the year. And on 31st March is the year end. That's when you charge depreciation. But 1st April is the start of the next year. There is no difference between 31st March 2024 and 1st April 2024 because the balance at the year day's end is the opening balance at the next day starting. It is the same. Now, after use for the entire year, during the first year, 10 percentage is charged on 1 lakh, that is 10,000 under both methods, SLM or WDV. But once during the next year, it's used under SLM, 10 percentage, assuming depreciation rate is 10%, 10% is charged on cost of machine. And the beginning, that is here is 10,000. But for WDV, this is where the variation is. On 1st April 2024, after charging 10,000 depreciation, the value remaining in the books, that is the book value or the return down value, is 90,000 rupees. So under WDV method, the depreciation charged at the year end of 1st April 2025 or 31st March 2025 is 9,000. That is 90,000 10 percentage. Okay. This is the concept. Because it's charged on the written down value, that's why this name of the method itself is written down value method. So clear? Copy it down. I hope you copy it as and when I'm telling you. If you're not copied it, pause it and we'll continue. Now, I'm going to start with sums now. But before I start with sums, one important concept should be explained to you. This is a very, very important concept. Only after understanding it, the other concepts will become easy. So this concept is called meaning of cost of asset. Now, at this time, many will ask me that you told it's a very practical concept. Why are you explaining theory now? If you have seen my videos, you will know that I explain a particular theory at a time before which the concepts are solved. Because once you understand the theory fully and explaining the theory in the practical way, so while doing your sums, it'll become easy for you. Every single this book is devised and this lectures are devised in such a way that a particular theory is explained at the right time, in a time where you need to know, where it's necessary to know. Now, to explain the concept of cost of asset, write this down, draw this table. Place of purchase of asset. Wait, just copy it down. Then place of use of asset. Wait, I'll explain. Just write it down for now. AS10 is Accounting Standard 10 of Property, Plant and Equipment says all expenses incurred during this time is added to the cost of the asset. Now, wait, one more point should be written. After that, the entire concept will be explained. Be patient. Wait, listen. Now, next one. Expenses. Once this table is understood by you, that is in the next 10 minutes, whatever the examiner can trouble you in, that problem is over. You just need to focus on concept from now on. Okay. Now let's start with explanation. I'll give you an example here. Now, you purchased a air conditioner from the showroom. Okay. Usually, the showroom people, they bring the air conditioner to your house and they install it. All those comes within the cost of the air conditioner. So, in order to bring it from the house to the showroom, the people in the showroom or the sellers, they incur freight, that is traveling cost. They incur salary of driver. Correct. They incur convenience charge. Then this installation charges. So all these are incurred to bring the AC from the showroom to your house. So my question is, will all these expenses go to the prop, because they're going to charge it from you only. They're not going to pay it on their own. They'll be included in the cost of the AC. So should you transfer all these expenses to the P&L account, or will be added to the cost of your asset? That is the question. Now, we don't need to use a lot of brain or logic for this because accounting standard 10 clearly tells you what you need to do. All you need to do in accounting is follow accounting standard 10. Whenever you're, especially when you're learning for a professional course like CA or CMA or CS. Now, AS10 says all expenses incurred during the time is added to the cost of the asset. That is, from the place of purchase to the place of use of asset. This entire time, the between process, the entire expenses incurred during this process or this time gap should be added to the cost of the asset. So the entire cost of freight, salary, convenience charge, or installation charge. Installation charge also comes before it's bought to the place of use of asset. That's how it's calculated. That's how it's assumed. Always assume installation charge is incurred before bought, like before the use of the asset, because after installation charge only you can use it. So before the use of the asset, installation charge is incurred. So that will also be added to the cost of the asset. This is the first concept. Now, second, you say that after you bring the AC to your house, there are many expenses, like maybe repair expenses, or you want to change the color of the AC, hypothetically. So there are lots of expenses. Should that also be included in the cost of the AC? Because this is done at one time before the AC gets installed. But repair can be done anytime, right? Like after the AC is installed, after 1 year we can do repair. After 2 years we can change the color. So how will that expense be treated? That is my next question. So that also is answered here by AS10. After you bring it to the place of use of asset, further expenses is divided into two parts. One, expenses that maintain the efficiency of the asset, and expenses that increase the efficiency of the asset. So this goes to the P&L account. This is capitalized. What does capitalized mean? Capitalized means, it's few people use S, that is also right for capitalized spelling. That means it's added to the cost of the asset. Okay. So here, when you bring the AC to your house, if the AC gets has some problem of cooling after 1 year, you have to repair it. So when you repair it, you bring it to the same level of efficiency that is working, that it was that the AC was functioning in at the beginning. Wait, for better clarity. Now, you repair after 1 year. After the second year, you add one extra cooling pump to the AC. It's very uncommon, but you add it. So now a 2-ton AC becomes a 3-ton AC, for clarity's sake. Now, again, we'll start with the example. Now the AC gets damaged after 1 year. It's not functioning properly. So you call the repair mechanic and you repair it. Now the AC is functioning as good as it was functioning beforehand. It's not going to function better than how you bought it for. But in this case, when you add an extra cooling pump to the AC, now the 2-ton AC is become equivalent to a 3-ton AC. So what does it mean? Now the cooling capacity of the AC is increased. Now it gives more cooling. So now it functions better than, or more efficiently and effectively than how you bought it. These are the two separate types of expenses. So first expenses, you're just maintaining the efficiency of the AC. You're not increasing the level efficiency level of the AC. So this is will be transferred to the P&L account as mentioned here. And this expenses that increase the efficiency of the asset. Here, because you add an extra cooling pump, now the AC functions more effectively. The efficiency is increased. So this will be capitalized. It will be added to AC account, this value. Now, while doing these sums, the entire concept will become clear. But for now, you keep this theory in mind because your concept will become clear easily now. Now, to understand this fully, I'm going to give you one very, very practical example. Now, you're purchasing an auto, and after 1 year, you're paying repair charges. So, when you're paying repair charges, you're trying to maintain the efficiency of the auto. You cannot increase the efficiency of the auto by paying repair charges or repairing the auto to more than how you purchased it for. This is be transferred to the profit and loss account as given above. Any further expenses after bringing to the place of use, if you spend on maintaining the efficiency, it will always be transferred to the P&L account. Now, again, 1 year time passes. You plan on changing the auto to CNG from petrol. So here, what do you do? You're actually trying to increase the efficiency of the auto. So the amount of money you pay to transfer from petrol to CNG, that value will be added to the cost of the auto. Right? As given in this example. After bringing it to the place of use, expenses that increase the efficiency of the asset will be capitalized, that is added to the cost of the asset. Concept is clear? Now, I'll give you questions and as to how examiners will ask you. Write this down. Question number 1. Cost of car 6 lakhs. Road tax. Now wait, it's a new term, but don't worry, every single term that the examiner can think of will be covered in this lecture. So just be free and listen to it carefully. Road tax 1 lakh. Second, insurance. Insurance is paid yearly. So insurance 10,000 per annum. Then registration charges for the auto. 1,30,000. Correct? Right? Now, what will be the cost of the car in this case? Let's start solving it. Now, before, what is road tax? Road tax is a one-time payment that you need to pay at the time of purchasing any car or bike or any auto, any vehicle. So, road tax is a one-time payment. So, it is paid before bringing to the place of use of asset. So, if it's paid before bringing to the place of use of asset, here it says it's added to the cost of the asset. Correct? So, cost of car is 6 lakhs plus road tax paid 1 lakh. Done. Now next, registration charges. Registration charges should also be paid at the time of purchase. It is before you bring it to the place of the asset. So registration charges 1,30,000. Now insurance. I told you insurance is paid on a per annum basis. Is to avoid the risk of loss, any accident or something like that. Now insurance is paid every year. and it is paid after bringing to the place of use of the asset, and is paid through the time of usage of asset. So further expense divided into two parts. Now insurance is only used to maintain the efficiency of the asset. Now your asset gets into an accident, you claim insurance. That insurance benefit they'll recover only to the amount of the insurance claim or the insurance contract you entered into the starting. You can't increase the efficiency of the asset by paying this insurance amount. You can only maintain the efficiency of the asset. Correct? So it won't be added to the cost. It will be transferred to profit and loss account, as mentioned here. So the total cost is 7 lakhs and 8 lakh 30,000 rupees. So this is the total cost of the asset. That is the car. Now, before we go to the next step, when I say total cost, what does it mean? It means when you bring the asset, this value should be entered into your books, not this value. This value should be entered into your books. The cost of the car, the value of the car that will be brought into the books is 8 lakh 30,000 rupees. Okay. Now, another case for complete clarity. Wait, I'll give you another case to understand every single point you have a doubt in right now. I've been through your step, so I exactly know what doubt will arise when. Now, second, now purchase price of car 6 lakh rupees. Then registration charges 1 lakh 50,000 rupees. Installation charges 20,000 rupees. Insurance of transit. Now, this is the new point they wanted to explain. Insurance of transit 10,000. Now, let's calculate. Same thing. Purchase price 6 lakhs plus registration charges because it's paid before you bring it to the place of use of asset. At the time of purchase, the registration charges is paid 1 lakh 50,000 rupees. Installation charges. Now, installation charges, like mentioned above, only after you install the asset in your place, it is said that it is bought into the place, it's then only used. It cannot be used without being installed. So, installation charges is always before the use of the asset. So, before you bring it to the place of use of the asset. That's what you have to remember. So, installation charges 20,000. Now, another question I get is, see, it's a car. Why am I paying installation charges? Correct. You don't have to pay installation charges for a car, but this is for concept. You imagine any other asset for this case. Imagine an air conditioner again. Okay. So now, when you pay installation charges, the main question I get is, you bring it home, it's bought to the place of use, then only installation charges is paid. Why won't it come under further expenses? This is the question in your mind, right? The reason is, you're right, but like I told before, only after install you can use the asset. So it is assumed that these charges come before it is brought to the place of use. Nothing else. Just keep this in mind. Installation charges is the only little different entry, except that no other entry in the world of accountancy is little different. So if you just remember this concept, you'll remember it throughout your life. Now, next part. Now, what is insurance of transit? So when I bring my car to my house, during this travel, if some damage to the car happens. It is possible. If such damage happens, in order to claim the loss amount for the damage, or in order to prevent the risk of such damage, insurance of transit is paid. Transit means travel. It is to ensure the safe travel of the car from the place of the cars, that's from the showroom to your house where the car will be used. So this insurance is also a one-time payment. It is paid before you bring it to the place of use. So insurance charges of transit will also be added to the cost of the asset. Correct? So here it's 7 lakh 50,000, 7 lakh 70,000, 7 lakh 80,000. Now, another question in your mind is, now the insurance charges paid per annum in this part, in the previous question, why is that not added to the cost of asset, and why is this insurance of transit added? See, the question is answered. This is per annum. This is paid due throughout the life of the asset, and so maintain the efficiency after it's brought to the place of use. That's why it's not added to the cost. But this one, it's paid before it's brought to the place of use. And this is for the travel part. That's why it's added to the cost of the asset. So this will be the book value of the car. This is the basic concept. Hope you understood it. There's no other question they can ask apart from this. Even if they ask, every other question that is mentioned in the coming lectures will be answered properly to you. Now, before proceeding further, you need to understand a very important concept of why depreciation came into place. If you understand this concept, the reason and rationale behind depreciation become clear. For now, then we'll start with questions. But before that, I want you to understand this. Now, for example, write this down. It's basis of depreciation. Now, see, I'm running a edtech business. So, say for example, in my profit and loss account, yearly fees, I get 8 lakh rupees. Let us assume I get 8 lakh rupees. Now the government comes and tells me that, why don't you pay tax on these 8 lakhs? Then I tell the government, no, how can I pay tax on this? Because 8 lakh is my revenue. I have incurred a lot of expenses to earn these 8 lakhs. So then the government says, okay, rent, salary, any advertisement given, all this totally comes to 2,50,000. Then you pay the tax on the remaining amount. That is 5,50,000. Then I tell the government, no, wait, but during this year, I purchased one furniture for my business, which cost 5 lakh rupees. And another board, white board, which cost 1 lakh rupees. Shouldn't I subtract that also? Now, in case the government gives me permission to subtract that also, this is not the right way. This is for understanding. Don't write this down, but pay attention. For example, we are assuming I subtract 5 lakh rupees for furniture and 1 lakh rupee for board. I get a net loss of 50,000 rupees. Correct? And the rule is you don't need to pay tax during net loss. That is the rule. So if I purchase a fixed asset, so it's best, right? Whenever I'm getting a lot of profit, I'll purchase a fixed asset. Then I'll reduce my profit and make it a loss and not pay tax. That's the best way to save tax. So in order to avoid such things, what the government did was, let me erase this. That's when the government brought in the concept of depreciation. So what the government told us was, as it told us to estimate how many years this furniture will come for. I say it comes for 5 years. And the board, I assume, will give me benefit for 3 years. So now the government says 5 lakh rupee you bought it for, he'll give you benefit for 5 years. 1 lakh rupee you bought it for, he'll give you benefit for 3 years. So then divide it and just take the benefit of the expense for 1 year. That is, for this year, only 5 by 5. That is 1 lakh rupees value benefit is only taken during this year. So the furniture depreciation is 1 lakh. And this board at the end of this year, 1 minus 3, 33,333 rupees, 0.33. But for now, I just rate 33. So 33,333. Correct. So during this year, I took only 1 lakh worth benefit of the furniture, which is worth 5 lakh. Because 5 lakh divided by 5 is 1. This 1 year, it gives 1 lakh benefit. And board also, 1 lakh benefit will be taken over 3 years. So 1 lakh by 3, 33,333 will be this year's benefit taken. Correct. So now I have a proper net profit, right? For CA foundation, you are allowed to use calculator. But if you're watching the same lecture for 11th standard, make it a point not to use calculators. Because it'll be easier. The numbers given in CA foundation will be a little harder than the number given in 11th and 12th. Because they're only testing your accountancy capability. So it's okay to use calculator for CA foundation, but for 11th and 12th, make it a point not to use any calculator. Now, net profit after using it, using the calculator, I get 4,16,667. Now I have to pay tax. Before I didn't have to. So in order to extract tax from us, this concept of depreciation came in. The government does not do anything for the benefit of the businesses. Yes, it does. But the concept of depreciation is not to give any benefit to the business or for taxation purposes. It's for government to get consistent perpetual tax. That's the reason depreciation is charged. It's the basic rationale behind depreciation. I want you to keep this in mind. Now let's start with questions. Okay. So write this down. Example 1. This is a timeline. Now, whenever there are multiple dates given in the question, which you will see in the next lecture, I'm going to do all the questions that is possible to be devised in this chapter, irrespective of the level. Now, you always write those different timelines in this line. It'll be very easy. If you won't miss anything. Now, April 1st. Now, June 2022. Then July 2022. Then 31st March 2022. I'll add another date. 1st November 2022. Now the entire concept of a new part of the chapter will get clear now. What I'm doing essentially is, depreciation is like a big boulder. If you throw it at once in your head, it's going to do some serious damage. So I'm breaking the big boulder into small rocks, into soft pieces of rocks. I'm throwing it one by one. So you catch everything at the right time and the right pace. And at the end, you'll be shocked that you completed the lectures and you're able to solve every single concept of depreciation easily. That's the reason I'm doing it in this sequence, in this order. Now, this year started on April 1st, 2022. On 1st June 2022, say a car was purchased for rupees 7 lakhs. Now, 1st July 2022, this car was bought in running condition. Wait, I'll tell you the meaning of running condition. Then from 1st November 2022, actual use of the car is made. Right. So I'll explain what this timeline means. So on 1st June 2022, you purchase the car from the showroom. On 1st July 2022, all this repair or any new adjustment, any new spare part change, you want to modify the car totally. All this modification is done. And on 1st July 2022, the car came in perfect running condition. That is from then you can start using the car. That's what running condition means. Then on 1st November 2022, you actually use the car. That is from 1st July to 1st November, the car was just staying in your business. You have not used it yet. This is what this entire timeline means. Now my question is, from what date will depreciation be charged? That is my question. Will you charge depreciation from 1st April because it's from year starting? Or a few people say, no, I charge it from the date car is purchased. So B says I charge from date car is purchased. C says no, even though I purchased it, it's not in running condition yet. If it comes to running condition, from then only I can charge depreciation in the books. That's what C says. Now D says that, okay, even though I bought it in running condition on 1st July 2022, I started using only on 1st November 2022. Depreciation should be charged only from 1st November 2022. So these four people say these four things. Correct? What are the actual answers? You fall in the category of one of these four. Accounting Standard Board also came into the same confusion while devising AS10. So they tell clearly what is the date from which depreciation shall be charged. So I want you to write a note here. Note number 1. As per AS10, depreciation is charged from the date on which an asset got got to its running condition. Write this note down. As and when you're revising, you'll go through the notes also. So your concept will be clear every single time. Now, this AS10 clearly says the depreciation will be charged from this date. That is, from the date the asset is brought into running condition or put to use. Now wait. What does this put to use mean? Now, if in the question it just says the asset is purchased on a certain date, it's brought into running condition on a certain date, then actual use is on a different date. In that case, you always charge depreciation from the date on which it's brought to running condition. But if it just says car is purchased and it's brought into running condition, there's no mention on actual use. At that time, you assume on the day it's brought into running condition, it's put to actual use on that date also. Put to use is basically put to actual use. This is assumption. Assumption if this is not there. Now another question. What if there is only car asset purchased on a certain date is mentioned? There is no entry of put into running condition or put to actual use. Then it becomes easy, right? we assume is put into running condition and actual use on the date of purchase itself. Make it clear. That's it. Now, what I told, write down little small points whenever I tell you. This is the basic full theory part of depreciation. The whole theory part I explained it in a practical way. Now we'll start with questions from the next lecture. Now, before going to the questions, I'll give you another small test or an explanation of a small aspect because I'm assuming you have no idea about depreciation. Now, in the same question, I say you have to charge depreciation from the date it's put to running condition, right? So, what will be the depreciation amount? This is the question. The depreciation will be, see, 7 lakhs. And let's make an addition to the question. In order to make it to running condition, they spend an additional 2 lakh. That is, you add some modification or you add some new stereo system and all those things. So to bring it to running condition, this modification and all is done. So this modification is increasing the efficiency of the asset. And this is done after it's brought into the place of business. So this 2 lakh will also be added to the cost of the asset. So this is the total cost of the asset on which depreciation will be charged. Don't worry, you'll do a lot of questions. This is just a basic new question that I'm giving you so that you read this and go home. So the next chapter I can continue with this and go in depth and give you full explanation of it. Now, how to charge depreciation? Assuming depreciation rate is 10% per annum. So 10% into what? Into 12? No, it's not into 12. 10% per annum. So that means whenever I say per annum, you have to divide it by 12. That is divided by the number of months for which depreciation will be charged. And I'm telling you depreciation will be charged from 1st July. That is from running condition. So from 1st July to 31st March. July, August, September, October, November, December, Jan, Feb, March. 9 months. So 9 months. So 9 lakhs into 3 by 4 into 10%. So it's basically 67,500 rupees. This is the depreciation. Now, if you already read it in 11th and 12th, you know how it's calculated. But I'm assuming you didn't read it. Now, why per annum I divided by 12? So the concept is take 10%, okay? But the first step is you divide it by 12 and you calculate the depreciation for each month. Then on top, why you did by 9 is you're charging depreciation only from 1st July. So from 1st July to 31st March, you're charging depreciation for these months. So you're charging depreciation for 9 months. So when you divide by 12, you get depreciation for 1 month. You're charging only for 9 months. So you're multiplying by 9, you get depreciation for 9 months. So 67,500 is the depreciation amount, right? So you keep this in mind and you go. From the next lecture, I'll start with the more advanced and most conceptual questions and different types of sums that is given in the PDF below. Thank you.